Netflix didn't just change how we watch TV. It changed how global companies think about growth. So let's rewind to 2018. Netflix posted its highest ever profit in the United States, and yet it paid zero federal income tax. You hear that right, zero. So now shift to the UK. Netflix generated over £700 million in subscriber revenue and still received a tax refund. Wait, what? How does that even happen? It's not about cooking the books, obviously. It's about knowing how to write the rules you play by, and using transfer pricing and international tax strategy to your advantage. So fast forward to today. Netflix is sitting on $7 billion on free cash flow. Next year, they're projected to hit $8 billion. All of it while avoiding excessive debt. No stock dilution. No wild financing maneuvers. So how did they do it? In this episode, we are diving into how Netflix structures its international profits. We will talk about transfer pricing techniques that shift income across borders legally, and what your business, whether you are CFO or a founder, can learn from Netflix playbook. This isn't just about taxes, it's about power, because the companies that master financial strategy, they don't just survive, they scale, they expand, and they finally, somehow, dominate on their own terms. Oh, and a quick intro, if we haven't met before. My name is Michael. I'm a lawyer and an economist by training, a business consultant and analyst by profession, and a business owner, like probably many of you. I run a company called Prezzo. You can check us out in the link provided in the description below. We specialize in transfer pricing, business analysis. We are helping small and medium-sized companies to scale by using tested and legal frameworks. We are working with over 100 companies yearly. And I get it. You all want clarity. You want real answers and recommendations. And most importantly, you want your business to grow without giving half of your profit away in taxes. That's what this channel is about, and that's what Prezzo is about. So if you are growing a company, trying to scale across borders, structure smarter, or just not get crushed by paperwork, this is the place for you. Now, today's episode is especially for CFOs, tax advisors, entrepreneurs, and international business advisors. Anyone who's ever asked, how do the biggest tech companies finance global expansion without raising capital, giving up equity, or going into debt? Because here's the secret. They don't just make money. They know how to keep it in the right jurisdiction, at the right time, within the right strategy. Today, you'll learn why cash flow, not just profit, is the real engine behind the global expansion. How Netflix used transfer pricing and deferred taxation to preserve liquidity. How those tax savings didn't just sit on a balance sheet, they funded content, opened new markets, and built the global empire. And yes, the risks, what's changing, what's being challenged, and where even Netflix is now under pressure. So this isn't a tax loophole story. It's a strategy story. It's about designing a business that can scale across borders without being eaten alive by inefficiency, or bad structuring. So if you want to stay competitive in a world where margins are tight and every dollar counts, stick with me. This episode could change how you think about cash, compliance, and control. Let's kick things off with a simple but powerful mindset shift. Profit is just a metric. Cash is a resource. Profit is what looks good on paper. Cash is what keeps the lights on, pays your team, funds your next move. So here's the trap. You can be profitable and still go bankrupt. Let me say that again, because it's critical to understand. You can be profitable and still run out of money. Why? Because profit includes things like depreciation, unrealized income, right? It can be future receivables that haven't actually hit your account. Meanwhile, cash flow shows what's real, what's available, what's liquid. That's the difference between we closed a $5 million deal and we actually received the money. So the history is full of companies that learned this lesson, and unfortunately the hard way. You can name it here like Kodak, Blockbuster, Toys R Us, all profitable at various points, but unable to manage cash when it mattered most. So what did Netflix do differently? They understood this from the very beginning. They weren't just trying to grow fast. They wanted to grow with the feeling of control. Think about their business model. Heavy investments in original content, global platforms, infrastructure, licensing deals that span jurisdictions, and a burn rate that would make a traditional CFOs really sweat. To sustain this, they had two options. Keep going back to the capital markets. So that means raising equity, maybe adding debt, or keep more of what they already earn. And here is the strategy that kicks in. Netflix asked, how do we fund our growth without constantly diluting shareholders or betting on volatile credit markets? And the answer is, we need to design a tax structure that reduces the leakage, maximize after-tax cash flow, and preserve liquidity to build long-term financial independence. Because if you can hold onto more cash today, you can reinvest it tomorrow. That's not just a tax play, that's an entire financial strategy. So how exactly did Netflix pull this off? Let's break down this the core components of their strategy, because it's not one trick. It's a system, an architecture, and it's built on three main pillars. First is content amortization. Netflix spends billions every year producing original content. Think about Stranger Things, The Witcher, The Bridgerton. These aren't just shows. They are obviously assets. Under tax law, many of those production costs didn't hit the books all at once. Instead, they are amortized, spread out over several years. I'll give you an example. You're spending $100 million on a show in 2024, and that means that you might only report $20 million in cost that particular year. It's like building a tax deferral engine using your own content library. Second pillar, intellectual property structuring. Here's where the things get international. Netflix holds the key intellectual rights, the rights to distribute and monetize the content in entities based in the Netherlands. This is obviously no accident. What happens next is classic transfer pricing. Netflix subsidiaries across Europe, you can say like in France, Germany, Spain, don't get content for free, right? They license it. So they pay royalties to the Dutch entity in exchange for distribution rights. Those royalty payments do two things. They are deductible in the local country, and at the same time lowering taxable income in those countries like France, Germany, etc. They accumulate in the Netherlands, where the tax treatment of IP income is, let's say, strategically favorable. So in short, income moves from high tax to lower tax jurisdiction within the group, but legally justified by IP usage. And the third pillar, loss carry forwards. This one is one of the most underappreciated tools in international tax planning. In the early years, Netflix invested aggressively. That meant they booked net operating losses on paper. They were losing money every year. But here's the trick. Those losses, you don't just forget them. You carry them forward. When Netflix eventually hit high profit years like 2018, they used those historical losses to offset the profits. In other words, so make money now and pay tax later. In 2018, this cocktail of amortization, royalty deduction, and loss carry forward led to zero US federal income tax and a tax refund in the UK. Now, before you call this a tax dodge, let's be clear. These are legal tools available to many companies, but using them well, that takes design, discipline, and some foresight. And it's not without risk. In 2022, Netflix paid over 50 million euros to the Italian tax authority following an audit into its European operations. It's a reminder that global tax strategies, while powerful, don't come without scrutiny. Case study contrast. Why strategy matters. So, Netflix story shows what's possible with the right tax architecture. But what happens when companies lack of financial control? Let's take a look at Spotify. Despite its global reach and popularity, Spotify has struggled with profitability for years. The key difference is ownership of IP and the development leverage. Spotify pays massive royalties to record labels. It hasn't the same ability to shield cash through IP-based structures. Netflix can funnel their global revenues, and actually, as a result, even with a loyal user base, Spotify has repeatedly returned to equity markets, diluting shareholders and compromising their control. Same space, different structure, entirely different outcome. So let's connect the dots, because this isn't just a story about reducing tax bills. It's a story about buying freedom. Freedom freedom to choose your own path. Freedom to scale on your terms. Freedom to outgrow the competition without begging for capital. Netflix used its tax strategy to retain more cash, and they did something crucial with it. They reinvested, not in share buybacks, not in short-term tricks to boost the stock price for some time, but they reinvested in 3 strategic pillars that build a global empire. First, content. We all know it. Netflix didn't just license the content, they created it. That's changed almost everything. They wrote it, they produced it, and they owned it. These shows didn't come cheap. We sometimes know how much they paid for it. We are talking about $10 million plus per episode, entire seasons shot across multiple continents, massive production crews. But here's the difference. Because of the liquidity freed up by smart tax structuring, Netflix didn't need to beg investors for cash. They didn't need to dilute the ownership. They funded these productions internally, turning tax efficiency into viewer loyalty. And that content, it drove new subscriptions, which drove new, fresh revenue, which fueled the next round of content. So that's crucial. Second, international expansion. Netflix didn't just go global. They went global pretty fast, launching in over 190 countries in just a few years. But here's what that actually requires. So this approach requires proper data infrastructure, regulatory compliance, localization teams, region-specific content, which is crucial for new subscribers, payment integration across dozens of tax regimes. It's, I would say, not cheap. But thanks to the retained cash, they could move faster than competitors and customize for each market without waiting for a funding round. Internal financing meant they didn't need to ask permission to grow. And finally, the third part, maybe the most underrated benefit of all, strategic independence. By avoiding excessive debt and protecting the equity, Netflix gained the freedom to focus on long-term growth, not quarterly earnings. So, while other streaming platforms were cutting budgets, restructuring deals, or chasing Wall Street's expectations, Netflix could take risks. They invest early, play the long game in this world, which meant a lot. So that's how you win a content war. You own your timeline. Okay, let's sum up some numbers of Netflix. Free cash flow, $6.9 billion. Revenue in Q4, $10.25 billion. EPS, $4.27. Beating the expectations. They have over 280 million subscribers globally. Those are numbers most CFOs would dream of. And it wasn't just product market fit. It wasn't just great shows. It was strategy from the back office to the boardroom. So from the tax structure to the content library. Of course, no strategy is bulletproof. And Netflix, they are learning that the hard way. Because when you operate in over 190 countries, move billions across borders and pay minimal tax in high revenue markets, well, sooner or later someone's going to knock on your door. Let's look at the facts. In Italy, Netflix faced a major investigation into how it was generating revenue from Italian users without having a physical presence there. That ended in over 50 million euro settlement. In France, regulators are examining whether the local entity is getting its fair share of income, or whether too much is being funneled to the Netherlands via royalties. And even in the Netherlands, long considered a friendly jurisdiction, there is an increased pressure on the government to clamp down on conduit structures and used by multinationals. It's not just Netflix. It's a wave of regulatory pushback, and it's only getting stronger. There are two major risks here, and both are accelerating. First of all, it's a reputational backlash. When a company earns hundreds of millions in a country but pays close to zero in tax, it doesn't sit well. Not with governments, not with voters, not with your customers. So it's not just like a headline problem. It's I would say trust problem. We've seen this before in some other companies, like Amazon boycotts in the UK, Google protests that happened some time ago in Spain, Starbucks that were grilled by the UK Parliament for tax avoidance. And when the narrative becomes like you benefit from our markets but don't contribute, expect more than just PR heat. Expect regulatory action. And second, the policy evolution. Pillar 2 and the 15% floor tax. The OECD isn't just talking anymore. They are implementing those rules. Under the new Pillar 2 framework, a global minimum tax of 15% is being rolled out. And this is how it works. I explained that in some videos some time ago, so you can check it out also, but just a short explanation. If your company shifts profits to a low tax jurisdiction, say paying 5% in Ireland or 0% in Caribbean, other countries can apply a top-up tax to bring the effective rate to 15%. In other words, the benefit of moving profits offshore, it shrinks. Your local country can still collect what's missing. So that's a massive shift. And it's forcing multinationals to rethink how they allocate income, where they hold IP, and how they structure intercompany payments. For Netflix, this means constant model refinement. More transparency, more audit defense, more cost to compliance ratio. But what does it mean for you? If you are a CFO, tax director, or advisor working with international operations, now's the time to take a hard look at your structure. Are your IP and licensing flows still defensible? Do your local entities reflect real economic activity? Is your transfer pricing documentation robust or just reactive? Because the rules are evolving fast. And what worked 5 years ago might invite an audit next quarter. So what's the path forward? Because let's face it, the world of transfer pricing and tax planning is changing fast. But the goal remains the same. Build a model that's smart, resilient, and built to last. If you operate internationally, here's the new reality. It's no longer about maximizing every loophole. It's about balancing efficiency with credibility. It's about crafting a tax model that scales without setting off alarm bells. Start with this principle: substance over form. If your entity in Ireland is reporting 100 million in profits but has no employees, no office, and no clear function, that's a solid red flag. Tax authorities are getting really better at asking, where is the value really created? They can also ask, where are the people, the decisions, and the risks? To stay safe, align your profits with real economic activity. That's really crucial today. It's not just compliance, it's also credibility. Next, documentation. You can have the cleanest transfer pricing policy in the world, but if it's not backed by real defensible documentation, it won't survive. That means solid transfer pricing studies, functional and risk analysis, intercompany agreements that reflect actual behavior. The crucial part is benchmarking. You should have benchmarking that's updated, not just recycled. And third, get ready for the global minimum tax. Under Pillar 2, top-up taxes are coming. If your effective tax rate in a country is below 15%, another country, even your home country, can tax the difference. That changes the entire incentive structure. It's not just low tax versus high tax. It's now, where do we have real activity? Where can we defend our structure in every jurisdiction? How do we create resilience, not just savings? This isn't just tax strategy anymore. It's an entire global financial architecture. At Prezzo, we help businesses build tax models that work, not just in the good times, but in audits, reforms, and boardroom decisions. Because sustainability isn't just about compliance. It's about stability. A structure that adapts, survives, supports your growth, quarter after quarter, market after market. Netflix proved that's really like what's possible. They proved what's possible when you play smart. But staying ahead, that's about being ready for what's next. You need to foresight the future somehow. If you found this helpful, please hit that subscribe button. It's really important for us. Drop a comment with the next company or topic you want us to break down. And check out the next episode, where we will look on some specific topic that might be very interesting for you. What's next for Netflix? Netflix model worked brilliantly in the last decade, but the landscape's shifting fast. As BEPS enforcement ramps up and minimum tax floors take hold, even Netflix will need to rethink parts of its structure. So, will royalty-based model remain viable under OECD scrutiny? Will the Netherlands continue to offer the same benefits in future? How will cost-sharing models adapt as content production globalizes? Meanwhile, competition is intensifying. Disney+, Amazon Prime, Apple TV, all investing heavily and catching up fast. Netflix's edge was always strategy. The next test will be the adaptability. Smart planning got them here. Smart evolution will decide what comes next. So let's jump into conclusions. Let's bring it all together. Cash flow is more important than profit because cash is what fuels your next move. Netflix tax planning wasn't just clever, it was strategic. It helped them keep more capital in-house. What capital powered original content, global expansion and strategic independence. But no strategy is without risk, especially in today's world. Between reputation, regulations and Pillar 2 reforms, the bar is getting higher. So what's the main takeaway? Please, and actually you don't need to copy Netflix. But you do need a tax strategy that's sustainable, defensible, and built for scale. Because in global business, the winners aren't just the fastest, they are the most resilient. If this episode gave you new insight, hit subscribe. We are breaking the real world strategies used by real global companies every single week. Have a question? Want to explore how this applies to your company or your clients? Or your small business, even if you're just starting? Drop it in the comments, your thoughts or questions. I read and respond to everyone, and let me know which company you want us to break down next. I'm Michael from Prezzo. Thanks for watching, and I see you in the next one.